Welcome back to This Week in Finance, where you can keep up to date in everything business, property, investing and finance related in the UK. Today we will look at a new ISA, the troubles ongoing in Birmingham and Martin Lewis's urgent warning. Premier Miton is calling for a new Great British ISA designed to invest solely in UK equities. The asset manager wants UK policymakers to add a further £5,000 to the annual ISA allowance, assuming these 8.4 million people invested the maximum £5,000 in the GB ISA. £42 billion could be raised for the British businesses in the first year alone. These inflows could support improved company valuations, keeping them from listing overseas and help to defend the UK's best companies from being taken over by overseas buyers. Of course, businesses are going to list in places where lots of capital can be raised, so if there's more money in the UK stock market, there's more likelihood that these businesses are actually going to stick around. These proposals are the complete opposite of the radical overhaul of the ISA system called for by AJ Bell. They pointed out that ISAs are currently too complicated. The proposal leaves a flagship one ISA savings and investment vehicle with a single set of rules. You might appreciate at the moment the balance of having an investment ISA alongside a cash ISA. If this is merged into one and you're limited in your options, it means you're stuck with one provider for both. So whilst one retailer might have a great broker system, perhaps the interest rate inside this broker is now considerably less. Whilst a one ISA system could make things more minimalistic, I think an individual just needs to do a little bit more due diligence and they'd easily be able to find out what suits them best. In a not so distant future, I could see the idea of ISAs being limited to UK only equities, which means that more of the money is kept in the UK economy, which promotes the overall stock market of the UK, adding liquidity, and also could encourage future businesses such as Leg PLC to therefore stay on the London Stock Exchange. They could look to reduce the annual deposits, they could look to add a lifetime allowance, or they could limit the investment potential to UK only businesses. Each of these do add a boost in some way, shape or form to the UK's economy and finances. Anyone that looks to reduce the ISA will likely lose votes as a party, and therefore it's probably not a wise idea if they do choose to do so. I think it's good to be mindful of what might happen to ISAs in the future so that we can remain adaptable as individuals. Britain's second biggest city effectively declared itself bankrupt, halting all spending except on essential services. The deficit arose due to difficulties in equal pay claims. The city now expects to have a deficit of £87 million for the financial year. They also blamed £1 billion of funding taken away by successive Conservative governments. A spokesperson for the UK Prime Minister, clearly it's for locally elected councils to manage their own budgets. The council's leader said that the new jobs model would be brought into the council to tackle the equal pay claims bill. And they've got problems ongoing inside the council and this should have been addressed. The fact that they're now saying that they're looking into a new jobs model suggests that they haven't been doing much, if anything, in the last 12 years and have likely been very idle. The council is left with limited opportunities to raise money without government support. They're likely going to look to increasing council tax. However, this needs to be carefully analysed. Increasing council tax can therefore reduce the overall cost of living in the area, and this could push down property prices. Bank of England governor told MPs that we are much nearer now to the top of the cycle of rate rises. It's expected to raise borrowing costs again later this month, taking the bank rate to 5.5%. Although inflation fell to 6.8% the year to July, down from 7.9% in June, it is still much higher than the government's target of 2%. The problem with the Bank of England, and central banks for that matter, is that they are reactionary rather than forward-looking. They may already be increasing interest rates to too high of a level, but won't realise this until 2 months' time when that data is then available to them. The main thing to watch now is wage growth. This is a key driver of inflation, and if this continues to be persistent, it can create problems for the bank. I personally think that we are very close to the peak of interest rates at the moment. In about 2 to 3 years' time, we'll probably settle down to a level around 4 to 4.5%, and I think it'll be a scramble from the Bank of England as they've increased rates to rapidly cut them down a few notches to make sure inflation stays around that 2% target. Martin Lewis said, urgent savings update, lock away money in total safety as national savings launches a 6.2% 1 year best buy, better than any fix of any length. The newsletter did warn readers that their money would be locked away for the entire year if they opened the bond. They also noted that savings in this bond were taxable. The minimum balance is £500 and the maximum is £1 million per person. Could be good for bigger savers such as someone who has sold their house. There are two versions of the account. Both pay the same rate. Guaranteed growth bond, which pays interest at maturity, or a guaranteed income bond which pays interest monthly. This may not be available for long because it has rules that means it can't overly distort competition. inflation. At the moment, if you fix your money into these bonds, it is still below inflation. But that said, what's the alternative? If you put your money in cash, you're losing 6% of spending power per year. Since the money is fixed for 1 year, it wouldn't be a great place for an emergency fund, because if there is an emergency, well, you better grit your teeth, work on the corner and hope for the best, because in a year's time, you're going to get your money back. That said, NS&I is considerably safer than the FCA because the FCA only protects up to £85,000 in savings. NS&I products protect every single penny. Higher rate taxpayers may not find this as lucrative of an offer because they'd be paying 40% on interest earned. If this GB ISA continues to provoke attention, HMRC could crack down further on ISA investors. To find out more, then click here.